All right, Tesla is down 48% from its all-time high that it reached back in late 2024. So we want to take a look at the revenues, the profits, the cash flow, the balance sheet. And we want to see, do we think this is a great buying opportunity for this Magnificent Seven stock? So let's get right into it. Looking at this chart, Tesla right now is trading at $250 a share. We see that had a significant downtrend as of late. So is this a good range to buy? That's the question we want to answer today with this analysis. Looking at the other stats, one thing that I don't like typically, the way I like to invest, beta of 2.51. That means every time the market goes up $1, Tesla's going to go up $2.50. Every time the market goes down, Tesla's going down $2.50. So more than double the volatility of the market. So that is, for me personally, that is a strike against the stock. I don't like that much volatility. The PE ratio, 121.9. That is $121 going to this company for every $1 of earnings. That's what you're buying. So this is a very expensive stock right now. Earnings per share of $2. So is paying $250 for $2.05 of earnings a good deal? It all depends on how fast those earnings are growing. So we want to look at that and pay attention to that as we go through this analysis. So going through straight to the revenues, we have Tesla starting out $4 billion in sales in 2015, all the way up to 97 billion. Okay, but look at this trend right here. You have this growth that's 73, 68% growth. That's awesome. Down year right here, 14, but back up to 28 and 70 and 50. Awesome. But look, 18% growth. And then right here, horrible. Less than 1% growth in 2024. Is this a sign of what's to come to Tesla? Is this industry hitting a wall? We have to keep that in mind as we're looking at that. Let's look at the margins. Gross profit, meaning all of their costs are taken care of. When they bring in money, of course, you got to incur costs for the product. Once the product is delivered to the customer, what's left over? We go from 924 million to 17.4 billion, but again, that's less than last year. So not only is the revenue kind of flat from last year, the gross margin is down from last year. Not by a whole lot, but that is significant to think about a company at this state if their margins are not improving. We don't like that. So let's get into profitability. Let's look at net income and see where they're at. First profitable in 2020. We understand that. But again, great growth these few years and then down. Profit, again, revenue's flat, but profit is in half of what it was last year. I would expect profit to be around the same. I want a close to 20%, or excuse me, close to 15% net profit margin, but no, they're at 7.3%. So they dropped more than 50% on their profit. That's one of the reasons why this stock is sliding so much. Horrible trend that seems to be starting right now, but we'll see. This could be just a bad year, but we'll see if they pick it up. Free cash flow, similar story. Negative, we get into some positive years, 2019. High growth, and then it's starting to tail off and go down. So we're trending in the wrong direction. 2 years of negative free cash flow growth. So negative 42, negative 16, horrible. We don't want to see that as we're looking at companies to invest. Too many companies are growing to invest in companies that are not growing. It doesn't make sense. One bright spot for them, the balance sheet is very healthy. They had some horrible years here, 2015 to 2019, but as you see from 2021 on up, free cash flow or debt to free cash flow, meaning they are producing cash to pay off their debt, 2.5, 1.5, 1.6, well below that 3-year threshold that we'd like to see. 3 to 5 years is okay, but anything under 3 years is great, and they have a very healthy balance sheet. They can pay off their debt from the cash flow in very quickly. So why is that? Well, we see their debt did increase, but ever since 2019, that debt is coming down slowly. So revenues are not growing as much, but they're being smart. They're paying off their debt. They're not keeping debt on the books in case they get into trouble. They have a cash flow to knock out the debt quickly. So that's smart by the management there. But let's look at shares outstanding. Shares outstanding, steady, growing. I think it was about 3% per year that Tesla has been selling shares and growing their share count. That dilutes the shareholder, but this company has been growing at a faster rate than 3% per year. So yes, dilution is happening. However, they are growing the company much faster than the dilution is happening. So it shouldn't have a major impact on the ownership of the company, the value of your shares. However, this is something you want to keep an eye on. You don't want a company to continue to dilute you as a shareholder. If it's a short-term trend, and even now that you want to see a company do this because Tesla shares have been overvalued for a while. So it does make sense to sell shares and bring in excess capital that's no interest tied to it. It's totally free. Bring in some cash for the operations, and you're selling shares when the company is overvalued. So the share policy as of now, I would say is good, not ideal, but it's good. Let's look at their returns on capital. Are they adding economic value by keeping their doors open? We'd like to look at the return on capital. We got 12.8% returns on capital. That means the equity and the debt that they have on hand, they're earning 12.8% on that. How much does it cost to get that capital? If it's debt, there's interest associated with that. If it's equity, if it's cash, the opportunity cost is about 10%. I can invest that into the market and expect to get 10%. So I want to look at the weighted average cost of those items, my capital or my debt and my equity that makes up my capital, and compare it to how much it cost me to obtain that capital. Unfortunately, Tesla has 12.8% return on capital, but it cost them for the past 5 years, 14.4% annually to have that cash on their books. What does that mean? That means they are losing value, economic value as an entity. And many auto companies are in this space where right now, over the past few years, they have negative value creation because they have more cost of the capital than they are returns on the capital. So that's not a good sign for Tesla. Again, there's so many other opportunities to invest at that and get a better rate of return. So this might shock you. It might not. We'll see. But based on my analysis, now I think I'm being generous with the growth rate of their cash flows of 32% over the next few years. But it seems to be that this is the bad year and their revenues are going to start picking up a little bit more in the future, and they should be able to continue to grow their cash flows. Their discount rate is 14.5. That's the hurdle rate that I have. And terminal value, I expect that if I were to buy Tesla today, I can expect at least to sell that stock for at least 15 times their free cash flow in the future. With that said, I have the stock horribly overvalued at about $34. That's what I think. Now, you may be thinking, how is that possible? Well, right now they're trading at 220 times free cash flow. That means for $220, that earns you $1 of the company's free cash flow. That's what your shares own. Does not make sense. Doesn't seem like that's a good deal, but that's what Tesla is trading at right now. And think about it. They're down about 48%. And right now they're trading at 220 times free cash flow. Think about this. If you have $220 and you give it to me and I give you $1, how fast do you want that dollar to grow to feel good about giving me $220? Let's say 100%. 100% growth means next year I give you $2. So you have $3, but I still have that 220. You're not going to feel good about that. If I grow at 100% again, that means the next year I give you $4. That's $7 that you've received. And I'm growing at 100%, very fast rate, but you gave me $220. How long before we reach that rate? So when you pay for a company that's this expensive, you have to think about what are you getting in return? If I give, is that just buying the shares on your app and okay, now you're an owner? Yeah, that's true. But what are you buying? What's the quality of your equity? This is not quality equity in my opinion because it's so expensive. And as we see, the revenues could be stalling. I could be generous. I could be overstating the growth right here. So which means it could be worse. Now you think, well, if the stock is trading at 220 times free cash flow, how do you expect, why not this? Why is this not much higher? Well, the average free cash flow that you can expect of the SP 500 in its totality. Again, right now we're overvalued, but you can expect 15 to 20 times free cash flow for great companies on average. So Tesla is a popular company. People are investing in this Elon Musk, the story of the company. They may be fanboys of him, so they're investing. I don't think people are really breaking down the financials and paying attention to what they're buying. They're looking at stock movement and seeing that momentum. That's short term. You want to pay attention to fundamentals. I don't care how fast the stock is growing. If the company is trash, it may be a trade, but it's not an investment. And we are fundamental long-term investors. So we don't put our money to trash scenarios like this one. Good company, good product. They do have some headwinds that we know, of course, the geopolitical issues with tariffs and things like that, and his involvement in the Trump administration is also affecting this. So in the short term, we don't know what's going to happen, but in the long term, I would avoid investing in stocks that tell me that is a greater chance that the stock will fall down versus go up, which means the fundamentals of the company don't support the valuation. So that's a red flag, and I stay away from those because I want to be a safe, smart investor. There's a whole lot of investments out there with consistent growth, and you can bet your bottom dollar they're going to have some growth next year, year over year, because they've been doing it. They're not facing these headwinds. They're not even the most popular companies. They're paying strong dividends with the ability to continue to grow those dividends. So there's a whole lot more smarter investments than Tesla for the fundamental, traditional buy and hold investor. So that's my opinion on this company. I think it's greatly overvalued. So I would say if you're looking to put money into this stock, I would say be careful. It's on a significant downtrend right now, trading below the 200-day moving average. The 500-day moving average hasn't crossed over the 200 yet, but with the looming recession, I would be careful with this one. So that's my analysis. Let me know what you think in the comments. Thank you for joining, and I hope to see you in the next one.